Welcome to your Mortgage Insider Update, March 31st, the end of the first quarter, the beginning of the spring selling season, just in time for the PCE report last Friday to come and really give a lot of a jolt to the stock market, which has pulled the stock market way down. It's actually about 3 days in a row of losses there right at the end of the quarter. At the same time, that money coming out of the stocks are going into bonds. And we saw just on Friday and today a heavy pullback on the 10-year Treasury, kind of a breath of fresh air for the bond market. This after a lot of buildup and a lot of anticipation to the PCE, personal consumption expenditure, which came out about in line with expectations, but not any worse than expected, which was really the breath of fresh air, around 2.5% year-over-year inflation. That is above the Fed's target of 2%, but better than it was last month at 2.6% year-over-year. So we'll take a look at what that means on the 10-year. So we start today's review on the 10-year at 4.22%, was over 4.3% just a short week ago, 4 basis points lower this morning, while mortgage-backed security prices are rising. We're going to take a look at that last. See the stock market being, the negative in the stock market is really the key to this. People pulling their money out of the stocks right at the end of the quarter. You're going to get quarterly statements coming out as of the close of business from results of the close of business today. And that's really helping the bond market at a time when we really need it as we come into the spring. We'd love to get some positive news out there for buyers to get interested in the market. So we can see this cliff we fell off after climbing the hill just in the last short period of time here. Since March 20th, we hit that low point. We kind of was created as a floor, the 200-day average. You can see that the steep slope here, we had a good run down overall on the 10-year Treasury yield, but we broke above that last week, right prior to the PCE report. A lot of talk around the tariffs. The worry that tariffs were going to create inflation was kind of the pretext of why rates moved up, peaked, and then Friday, just a breath of fresh air, dropped the 10-year down below the 25-day average, opening today right at and actually falling below the 200-day average. We'll see as this plays out. I think as this week progresses here, April 1st and 2nd, we're going to have the tariffs. It's not going to be delayed. The Treasury Secretary and the Commerce Secretary anticipate there to be tariffs for sure. To what level? Are they going to be the maximum pressure type tariffs, or is it going to be muted at the beginning but long term? And that seems to be the play that here, that tariffs are going to hit the market, and we're going to see how that plays out here over time. So that the big reason for the stock market to pull back is that threat, and then that has really helped the bonds. We'll see if we break below this week. In the inverse of the Treasury yield, we're going to look at the mortgage-backed security price. Now, the price to the investor, this is the investors buying the loans. The higher price they pay, the lower interest rate, like we can see on the 10-year, to the consumer. Similar story, only in reverse here. We saw prices pull back or down, so that was an elevation of interest rates last week in anticipation of the PCE and implementation of the tariffs. March 28th, we saw it move back up. Now, this is not as huge of a rise as maybe we saw on that 10-year chart. So mortgage-backed securities improved, but they didn't improve as significantly as we saw in the bar chart on the 10-year. So just something to keep in mind. We are seeing a reversal and an improvement. We're above the 25-day average. Brings us back to where we were back in the middle of March. We were kind of hovering in this area. We improved back March 20th and then pulled back. So as this week progresses, we're also going to be watching on mortgage-backed securities to hold above the 25-day average and push any higher. This line that we hit back on March 3rd was the low point in mortgage rate offerings. Now, that particular day, it actually jumped all the way up this level, and then we actually had an alert to watch for worse pricing, and we got it over the following couple days. So we're hoping to get back to those levels as we get into the early April and the spring selling season. So as this week moves on, we're going to watch for the unemployment numbers to come out from the Bureau of Labor Statistics on Friday. This will be a week full of employment information. JOLTS, the job openings report, comes out Tuesday. ADP, the private sector's job report, will come out on Wednesday. But the ultimate is the Friday report, which will actually get the unemployment rate, which is expected to go up slightly from 4.1 to 4.2%. Depending on how the numbers play out, it could post even higher than 4.2% unemployment rate. If that were to happen, we would see probably a lot more buying in mortgage-backed securities and a lot lower interest rates net to the consumer. So we'll keep an eye on that. It could come in flat. So we'll watch for that next report on Friday and make it a great week.